Okay, for this video tutorial, I want to go over Form 7203 for a shareholder in an S corporation where they have losses and they have stock basis and debt basis. So this video is a continuation or a follow-up from the prior example where John Smith is a S corporation shareholder. He had losses and the losses exceeded his stock basis, but he didn't have any debt basis. Right now we've modified the fact pattern a little bit where John is going to have both stock basis in the company, and then we're going to have to complete part 2 because he has shareholder debt basis as well. So I would recommend checking out the first video and then come back to this one if you haven't already seen it, because it'll help understand how the fact pattern is being modified a little bit here. So what we have in front of us is 7203, and it is part of the full return. So I do have a 1040 for John here, all the relevant schedules that he's going to need, and so we'll come back to not only the 7203, but all the other pieces that are kind of necessary to really illustrate how these suspended losses are working and the carryovers. And then we do have the K1 for John. So this is from his S corporation. He is a 50% owner and he is being allocated these ordinary losses here on line 1. So we'll look at the K1 and the basis reconciliations as well. And then lastly, we have a slide that covers the fact pattern itself. So again, I recommend looking at the first video and then coming back to this one. I'll put a link to that first one below. Go check that out. So 7203, again, high level, why is this necessary? In order to claim losses on your return, amongst other things, you need to adequately track your stock basis, right? So the general rule here is your deduction for losses and other kind of expenses on K1 is going to be limited to your basis in the S corporation, and that's your stock basis and your debt basis. Any losses or expenses that exceed those amounts, you generally have to roll them forward to future tax years. That's kind of the basic rule here. So in our fact pattern, how this is going to differ slightly from the prior video, we have again here John. He's the 50% owner in the company. He materially participates, so this is going to be a non-passive activity for him. Now on the equity side, what he did was he contributed $10,000 in cash to the company in exchange for the stock. So it was a capital contribution, and there's no dividend distributions during the year. So all we're being allocated here are positive amounts of income and the losses, and then no dividend distributions. Now, John, similar to the first video, he does have a second job, and he made $40,000 in W-2 wages from that job, and so that's going to be reported on his Form 1040 as well. Now, here's where we add the debt basis element to this. During the year, let's also assume that in addition to the $10K in cash that he put in exchange for the stock, he contributed $50,000 to the S corporation as a loan, right? So he loaned the company money, not in exchange for any property. He just loaned the money. It was a written note agreement, and the term of the loan was 2 years with a 5% APR. And during 2022, the company started immediately making payments on it. And so the total amount of payments made totaled $6,581. And that dollar amount is separated into $600 of interest and $5,981 in principal. Now, at the end of the year, the balance owed to John was $44,019. The company also sent John a 1099 INT to show the $600 of interest paid to him. Okay, so remember, the principal amount really isn't reported on INTs, but the interest amount is. Now, here's John's question, right? He's allocated K1 losses of $27,315, and he wants to know if he can offset some of those losses against his W-2 wages, right? And so can he reduce his taxable income by claiming these losses, right? So if we look at the tax return, so let's start with the K1 here, and we can see what John's looking at. So this is his K1, right? He is a 50% owner, so that's his current year allocation percentage. And what we see here in item I now, different from the first video, is we have some balances entered for the loans, right? So beginning of the year, no loans outstanding, so that's fine because this is a new company. But at the end of the year, the corporation did owe him $44,019. And so we've got his ordinary loss allocation here, $27,315, some interest and dividends being allocated, And then in item 16E is the principal amount of debt repaid during the year. And then 16C is just the non-deductible expenses. So we have some non-deductible expenses related to a work opportunity credit that's being claimed. Now, if we go down to an additional supplemental statement here, this is provided by the S Corp to John too. It helps him understand and reconcile what's going on with his note balance. So loan balance at the start of the year, $0, $50,000 in gross amount of advances. So that was the principal sum of the note. $5,981 in principal repaid, and the end of year loan balance is $44,019. And then we have indicated, yes, there was a written arrangement, and it's a shareholder loan with a 2-year maturity date. Okay. Now, the basis worksheet provided by the S Corporation, very similar to what we saw in the first video, except now we're modifying it in that we have the debt basis element too. So this basis worksheet has stock basis and it has debt basis amounts down here with some carryover pieces. So if we look at the stock basis reconciliation for John, remember our stock basis is increased by capital contributions during the year. There's the $10,000. It's increased by positive amounts of income, right? So there's the $25 in interest and dividends. It's reduced by non-deductible expenses. So $10,025 is the amount before accounting for these, $1,440 in non-deductibles. So his basis before factoring in losses and other deduction items is $8,585. Now, again, very similar to what we saw with the prior video. So the amount of loss he can take to the extent he has stock basis is only $8,585. So if he does that, remember, the total loss is like $27,000 and change, but he's only claiming $8,585 on this worksheet because of the stock basis limitation. So what we have down here is stock basis has been reduced to 0, right on line 11. And then we have his debt basis reconciliation here, which is just the new loans to the company minus the amounts repaid. All right, so that's what John has for this period, and that's what was provided by the S Corp. Now, what's really important to remember, and I like that the loss and deductions worksheet provides a nice note here, and this is very, very important because it's very true, right? Loss limitations are applied at the shareholder level. So these worksheets, informational only, may not match actual losses and deductions reported on the 7203, right? Again, that's so true, very, very important to remember. Although these might, under some circumstances, reconcile with the amount of losses you claim, what your basis might be in the stock, not necessarily always the case. And that's what we're going to see when we look at John's Form 1040. So if I go to the 1040, and we're focusing on 7203. So the 7203, very similar format to what we saw with the stock and debt basis worksheet here, right? We have the stock basis, the additions to it, the reductions, and then an ending balance. So the 7203, name of the shareholder at the top here, the company, the S Corporation that we're working with, the ID numbers, and then how the stock was acquired. So D1, we are the original shareholder. Now on C, stock block, what they're asking here is really just your own notations on how you're tracking the shares in the S Corporation. So in this case, we've just labeled our initial purchase as Block 1. The reason why this is important is because if, let's say, John, a year from now, buys out some of the stock from another shareholder, then that would be Block 2, right? You have to track each block of shares you get at different times because you're going to have different bases in each stock block. So in this case, John's only got one, so we just labeled it Block 1. But if in the future he got another block of shares because he either inherited it, it was gifted to him, he purchased it maybe, he would have to do another 7203 with Block 2 and track everything separately, right? Very important to remember. Now, in part 1, the stock basis reconciliation. Again, this looks very familiar to what we saw in the other worksheet, right? We have the basis at the beginning of the year, 0, the capital contributions, allocations of income, right? The positive amounts of income. So we have 5 and 20 there. So we have $10,025. It's reduced by the non-deductible expenses, $1,440. And then we have down here the stock basis on line 10 before loss and deduction items is $85.85. Now, Once you have that number, you would jump down to Part 3 and figure out how much can actually be claimed. So when we look at Part 3, the allowable loss and deduction items, we're working right now with just A through C. So A is the current year loss items and deductions. B are the carryover amounts. Because this is the first year, we obviously don't have any carryovers. And then what we do is we look at A and B and we combine them up and ask ourselves, okay, is this number greater than the stock basis number we have reported here on line 10? If it is larger, that means you have a basis limitation issue. And so what you would do in column C, report the amount that's allowable based on your stock basis. Because our stock basis peaks at 85.85, that's the ceiling, that's the amount of loss that we're going to be able to claim from stock basis alone. All right. Now here's where this changes from the prior video where we had just stock basis. If you don't have any debt basis, then column D is just going to be blank, right? Because we don't have any losses allowable from debt basis. So what we would see here, and you'll note this in the prior video, column D is blank and we have a carryover amount for the amount of loss in excess of basis, right? And that's what's rolled forward to the subsequent tax year. Now we have some debt basis, so we don't stop at just the stock basis loss issues. Now we can look at, okay, we've got some debt in the company, some shareholder loans, so perhaps we can maybe take some losses against those shareholder loan amounts. And that's what we have here now in Part 2, okay? So how does this section work? So Part 2, shareholder debt basis, split up into a couple of big pieces, right? So you are supposed to track if you have separate notes or separate shareholder loans with the company, right? So they give us 3 columns here, debt 1, 2, 3. In our case, we just have 1 balance. And so it is a formal note arrangement, so it's not open. Open accounts, think of them kind of more like maybe revolving lines of credit, where it's not necessarily written. It's kind of just, okay, you loan the money to the company and then take money in and out as you can. Which is very common, and that's certainly okay, if it's done appropriately. But in this case, we have a more formal note arrangement, and so we've indicated it as such here in column A. Now, one additional point on the formal note versus open account issues. The open accounts are generally okay so long as the amount of loan is under $25,000. There's a regulation that covers whether notes at or above that amount need to be written or in writing, rather. I always recommend to have it in writing. I think it just bolsters the position that it's a legitimate shareholder loan, but there are exceptions, right? So maybe you might be the open account section, but in our case, we're at $50,000, and because it was a high enough amount and everything John and the company wanted to do by the book, they had it in writing, stated interest rate, repayment terms, everything. Okay, so Section A, amount of debt. So we have debt 1, formal note. Loan balance at the beginning of the year is going to be 0, right? Because the corporation tax year started this year. So obviously there isn't any debt at the start of the year. So during the year, there was $50,000 in loans made to the company. The loan balance before the repayment, right? So combine the beginning of the year plus any new loans, if that was the case. And then track the principal portion of the debt repaid. So this amount, remember, this reconciles with the amount reported on as K1, right? So $5,981, and that's also reported up here in line 16E, right? So $5,981 was the amount of the principal debt repaid, and so the loan balance at the end of the corporate year is $44,019. Now, so this covers the amount of the debt, right? What happened during the year as far as money in and out. And then in Section B, we start to work on the debt basis that can potentially be used to claim some of the losses. Now we notice here that because he was repaid some principal, the debt basis that we can use before accounting for non-deductible expenses is the principal amount owed at the end of the year, right? That's generally what's going to be the case. And so what we can see here is their debt basis before accounting for non-deductible items but before accounting for losses and other deductions is $44,019. Now the reason why we don't have any non-deductible expenses down here is because we've already used the $1,440, that non-deductible item, in eliminating his stock basis. Right, so we already accounted for the non-deductible piece up here. It was applied to his stock basis. So we don't have any other non-deductible items that can be reported on line 28. So the debt basis before losses and deductions on 29, $44,019. And then the allowable losses in excess of stock basis, there's the extra. Right, so $18,730 was the amount of loss that he couldn't claim because of the stock basis limitation. So if you're trying to trace that number, so if we look at, remember the K1 for John showed ordinary losses up here of $27,315. So the $27,315, John was able to use, let's see, 85 against his stock basis, and so he had $18,730 in losses that were left over that were going to be suspended if he didn't have any debt basis. But in this case, he's got $44,019 in debt basis, so he can apply all this extra against that debt basis, $18,730. So now his debt basis in the notes, or in the stock, I should say, because of the shareholder loan, is $25,289. So when John looks at his tax return now, he's going to be able to get a deduction for everything. So if I go up to Schedule E, well, actually, let me go to page 1 here just to recap so we can see the similarities here. So again, this is John's 1040. He's got the wages up there. What has changed from the prior example, if we look at his Schedule B, he's got more interest income now. So let me go down to Schedule B. Yeah, so his interest income, he's got the amount passing through the $5 on the K1 from the company, but you can see here now he's got $600 in interest coming from the lawn care business because that was the amount of interest paid on the note. So that's one big change, is the interest on the note, certainly. And then if we look at Schedule E, so Schedule E, Part 2, page 2 of Schedule E is where we report the income or loss in the partnerships. And so we can see here that the amount of non-passive loss coming through is the full amount from the K1. So in column I here, we have $27,315. So if I go back to, let me pull up the 1040 from, so this is the 1040 from the first video. So you can see the wages are the same. The interest was different, obviously, because he didn't have the $600. But if I jump over to Schedule E, so this is the Schedule E from the first video, you can see here the basis limitation, right? So he was only able to deduct $85.85 because he only had stock basis. But now, because he's got debt basis, he can not only deduct the amounts up to the stock basis, but he has enough debt basis to absorb all his losses. So now the amount of loss flowing through on Schedule E Part 2 is $27,315. All right. So that covers it for this video. I hope that was helpful. If you have any other questions on the 7203 forms or other kind of basis issues for stockholders, please leave me a comment below. Happy to answer any of these questions I can, and I look forward to seeing you again on the next video. Thank you.